This is a half-hour video that will teach you more about money than you learned in 12 years of school. Enjoy. This course will be split up into 7 parts. Types of investments, the value of index funds and compounding, fears and misconceptions about investing, personal savings plans, how to protect yourself from the volatility of currency exchange rates, where to go to make investments, and the big picture. So let's jump right into it. Part 1. Types of investments. First, let's go over some basic definitions you should know before we start talking about investing. We're going to discuss stocks, bonds, GICs, mutual funds, and ETFs. If you already know what all of these are, go ahead and skip to Part 2 to go straight to the investing portion of this course. Let's start off with stocks. You always hear people talking about investing in the stock market, but what is a stock? A stock is a share of the ownership of a company. But what does that mean? When companies reach a very high market value, $100 million for example, they sometimes have the option of what is called going public with their business. This is what allows average investors from the public to buy shares in the company. Companies sell stocks in order to receive capital that they can use to grow their business. This growth is then reflected in the value of the stock that you purchased. So let's say you purchased one share in Apple for $200, and over the next 2 years the value of Apple as a company went up by 10%. If you were to take out your money after the 2 years, the value of your investment would have gone up 10% as well, and you would receive $220 for your $200 investment. Now, if the value of Apple were to go down 10%, then that would also be reflected in the value of your stock, which would now be worth $180. Investing in individual stocks can be very beneficial as there's a lot of potential to make a large return on your investment. However, it is also very risky. As much as it is possible to make a lot of money investing in stocks, it is also very easy to lose a lot of money. Contrary to popular belief, it is impossible to predict how well a specific company will do financially at any one time. More on that in Part 2. For now, let's talk about bonds. A bond is a debt security given out by either a government or corporation. What that means is you are essentially loaning money to a government or corporation with the promise of having that money paid back in a set amount of time with a set interest rate. Bonds are usually long-term investments of up to 30 years with low percentages of profit. They are usually locked in for a specific period of time and can't be taken out early. For example, let's say your local government was issuing a $1,000 10-year bond at a rate of 3% per year. You would give your local government $1,000 and the government would pay you 3% worth of your investment annually, in this case $30, each year until the end of the 10-year term. After the 10 years, the government would then pay you back your $1,000 loan. Many people invest in bonds because it is safe and reliable as you are almost guaranteed to make a positive return on your investment. That being said, because of the low interest rates, the profit margins are relatively low. A similar form of investing is through GICs, or Guaranteed Investment Certificates. GICs are also a loan, however they are given out to a bank or trust company instead of a government or corporation. Like with bonds, money is loaned out for a set period of time for a set interest rate. Some GICs give you the option of taking your investment out early, however these options will have a lower interest rate, resulting in less profit for the investor. Again, like with bonds, GICs are popular as you are guaranteed to make a positive return on your investment. Next up are mutual funds. What is a mutual fund and how does it work? A mutual fund is a pool of money that is controlled by either banks or other investment firms. These pools of money are managed by trained mutual fund managers who are hired by banks and investment firms to invest in stocks, bonds, and other assets in order to turn a profit. There are multiple different types of mutual funds that focus on many sectors of the global economy. For example, some mutual fund managers are focused on individual sectors like oil and gas, some on foreign markets like China or Europe, and some on emerging markets like newly developing countries and cities. But how do you make money from mutual funds? Like with stocks, the amount of money you make will be directly correlated with the value of all the assets in that mutual fund. Let's say you put $100 into a mutual fund. If the value of the assets in that fund were to grow 7% over the next year, your $100 would turn into $107. With that said, there are other factors to keep in mind before investing in a mutual fund. Mutual fund companies and investment firms vary in the charges they implement on their funds. Every mutual fund includes a management fee in order to pay mutual fund managers for their work, usually 1 to 3% of your total investment. Besides the management fees, every fund charges either a back-end load, a front-end load, or no load fee. With a back-end load, there's a small charge to the investor if the money is taken out from the fund within a certain period of time. This charge is typically reduced by the length of time the money is left in the fund, so a long-term investment could be taken out without having to pay any additional fees. With a front-end load, there is an additional fee charged when you deposit your funds, so you actually start with less than what you deposited. No-load funds have no fees when money is deposited or taken out, but there are usually higher management fees with this type of fund. With all these fees, the 7% profit you made on your investment could drop down as low as 4 to 6%, if not lower. The risk and potential return on your investment with mutual funds vary greatly depending on the type of fund and investing style of the fund manager. Many people, however, like to use mutual funds for their retirement savings, as they can invest in funds that match the amount of risk they are willing to take, that will give them a higher return than an individual bond or GIC, with less risk than investing in stocks. Finally, we have ETFs or exchange-traded funds. ETFs are similar to mutual funds in that there is a pool of money that is controlled by a fund manager at a bank or investment firm. There are two key differences, however, between ETFs and mutual funds. First, ETFs are sold like stocks, where you can purchase shares for a certain value, whereas with mutual funds, you can select a specific amount of money you want to invest. For example, if an ETF was selling for $25 per share, you would have to buy shares in increments of $25, as you cannot buy part of a share. With a mutual fund, you could invest an arbitrary amount like $55.73 if you wanted to. The other main difference between an ETF and a mutual fund is that ETFs usually run on an index of a market or sector of the economy. This will be covered in more depth in part 2 of this course. Essentially, there are 3 common ways you can invest your money. You can loan your money out like with a bond or GIC. You can invest your money directly into a company in the form of stocks, or you can pay somebody else to invest your money for you with mutual funds or ETFs. But which one is best for you? Watch part 2 to find out. Part 2. The value of index funds and compounding. This is without a doubt the most important portion of this entire course. If nothing else, make sure you pay very close attention to this video. What we're talking about is index funds and compounding. If you listened to the part where I was talking about ETFs, you would have heard me say that most ETFs run off of an index of a market. This means that most ETFs are index funds. But what is an index fund? An index fund is either a mutual fund or an ETF where the fund manager invests in every company or asset in a select market. Let's use the S&P 500 as an example. To put it simply, the S&P 500 is a collection of 505 of the biggest companies in the United States. So what the fund manager would do to create an index fund is buy shares in all 505 of those companies and let those investments sit to follow the growth of the S&P 500 as a whole. There are also many other index funds available, like an index of the TSX 60 in Canada. But what makes these so special? Let's go over some key facts that will help explain why index funds are the key to long-term financial stability. First, lower fees. With actively run mutual funds, the fund managers will often charge between 1% and 3% of the value of the fund as a management fee, since the fund managers are constantly moving investments around. Whereas with index funds, since the fund managers only have to invest in each stock once, the management fees are significantly lower, sometimes as low as 0.04% of your investment. You might think, does 2 or 3% really make that much of a difference? In the short term, no it doesn't. But over the period of a 45-year working life, even just a 2% difference in management fees would add up to you losing out on almost 50% of your investment. Why such a big difference though? The answer is compounding. If you've invested in a fund that is making you 10% profit annually, what compounding will do is every quarter, half year, or a year, that 10% will recalculate according to the current value of your investment. So at 10% with annual compounding, a $100 investment would turn into $110, then $121, and then $133.10, and so on. Suppose you have an index fund and an actively run mutual fund that give the same return of 10% per year over a 45-year period. The index fund has a management fee of 0.05% versus the mutual fund, which has a management fee of 2.5%, both compounding annually. If you were to put $10,000 in each fund and let them sit to compound over the 45 years, the index fund would give you a total return of $714,143.55, whereas the actively run mutual fund would give you a total return of only $259,048.39. That's almost $500,000 less because of a 2.5% fee. Compounding is a beautiful thing, but in order to truly get the most out of the effects of compounding, it's important to start investing as early as possible. To show you how valuable this is, I'm going to give you an example of two separate investors. The first investor, John, invests $300 a month from the time he's 20 until he turns 30. David, the second investor, invests $300 per month from the time he is 30 until he's 65 and retiring. By the time John is 65, he will have invested a total of $36,000, and with 45 years of annual compounding will have made $1,666,434.18 profit, totaling his investment at just under $1.7 million. David, on the other hand, will have invested a total of $126,000 and will only have made $901,768.06 profit, totaling his investment at just over $1 million. Just by starting his investing 10 years later, David spent $90,000 more than John and made almost $700,000 less. Now, if John were to continue his investments of $300 a month from the time he was 20 until he was 65, he would have invested a total of $162,000 and made over $2.5 million in profit, totaling his investment at over $2.7 million. That's over $2 million more than David made just from starting on his investments 10 years earlier. But if these mutual fund managers are charging you more money for them to pick out specific investments that they believe will be the most profitable over time, wouldn't those mutual funds be more profitable than an index fund that just reflects the growth of a market? Actually, no. What if I told you that index funds consistently had higher returns long term than actively run mutual funds? A man by the name of Robert Arnott did a study comparing all 203 actively managed mutual funds with at least $100 million in assets in the United States to the S&P 500 index from 1984 through 1998. What he found was that only 8 of the 203 funds actually beat out the S&P 500. That's less than 4%. So not only are index funds significantly cheaper than actively run mutual funds, but they also provide a higher rate of return almost every time. Now you might be wondering, what if I can find those 4% of mutual funds that will beat out an index fund? The problem with that is the 4% of funds that are actually beating the market over that 15-year period won't necessarily be the same 4% that beat the market over the next 15 years. If there are any that beat out the market, that is. Contrary to popular belief, it is almost impossible to accurately predict how individual stocks will do, and specifically how the market will perform, which is why index funds do so well long-term in comparison. As the multi-billionaire investor Warren Buffett once said, the only value of stock forecasters is to make fortune tellers look good. So how can index funds be so profitable? With the S&P 500 being 505 of the biggest companies in the United States, naturally they would have gotten there by being very successful. As the majority of their success continues, as does the value of their companies. Of course, once in a while there will be select investments within a fund that will not do well. However, because of the diversification and the number of assets in the investment, the majority of the companies that are doing well will bring up profits more than enough to compensate for the businesses that are not doing as well that year. From 1985 until 2015, the S&P 500 actually had an average return of 10.28% per year, with the average over the last century being at around 10%, 7 to 8% higher than the average rate of inflation, which in Canada and the US averages out at around 2 to 3% annually. Part 3. Fears and Misconceptions about Investing. Let's go over some fears and misconceptions people have about investing and some facts that will give you peace of mind with your investments. First, let's go over a few definitions. More specifically, what is a correction, a bear market, a bull market, and a recession? These terms you will need to remember moving forwards. A correction is when the value of the economy, or the market, drops by at least 10%. A bear market is when the value of the market drops by at least 20%. A bull market is when the value of the market increases by at least 20%. And a recession is when the economy declines for at least 2 quarters in a row, or 6 months. If you need to write these down, be sure to pause the video and do that now, as these terms are key to the remainder of this section. The most common fear is the fear of losing money. One of the biggest reasons people lose money on their investments is that when the value of their investment goes down, they get scared that they're losing money and they pull their investment out. This seems practical until you realize that you've never actually lost any money until you take the money back out. So as long as that money is still in your investment, you haven't lost anything at all. It really is that simple. Let's go over a few facts that will show you why you should never pull out an investment prematurely. First off, the US market hits an all-time high on average every month. Even disregarding everything else, that alone will almost guarantee that you will make money long term. But there's more. Corrections have happened on average once a year since the year 1900, and have only lasted an average of 54 days each. This means that despite the market always going up, there will always be small dips in the market. These dips are nothing to worry about, however, as they never last. Of these corrections, only 1 out of 5 becomes a bear market. Now, even if there is a bear market or recession, it is still nothing to worry about with regards to investments. In fact, as long as you can maintain a stable income, it can be a blessing in disguise. Every bear market over the past 100 years has always been followed up by a bull market. 2 of my favorite examples of the market recovering are in 1987, when the market went down 34% and still ended up with a positive return of 2%, and more recently in 2009, when the market went down 28% and ended with a positive return of 23%. This is where these bear markets can become a blessing. If you were to invest your money at the lowest point in 2009, then by the end of the year you would have had a 51% return on your investment. Essentially, the only way to lose money by investing in an index fund like the S&P 500 is if you're betting on the whole American economy failing permanently. Which, when you say it like that, sounds absolutely ridiculous, as the economy has always bounced back year after year after year. Just leave your money invested and it will always go up eventually. The second roadblock that keeps people from investing their money is believing that they don't have the money to invest. This is a reasonable argument, but I like to use an example I heard from Tony Robbins that really shows that anybody can invest in their future. What he asked was, if the government came and taxed you an additional 20% of your annual income, what would you do? You would yell, you would scream, you would complain, and you would pay it because you have to. You would find a way to adjust. For most people, starting off by investing just 10% of your income can be very beneficial. It might not be a ton of money, but it will be enough to build a solid foundation of investments. Now, there are some scenarios where 10% or 20% might not be possible. Let's say you're on a single minimum wage income while trying to raise a family. Start with investing just 3% of your income. From there, you can make the decision if it's possible to invest more of your money into the market. And as you get used to the lifestyle adjustments, you can begin making bigger investments. No matter the situation, there's always a way to find money to invest. Part 4. Personal Savings Plans. This portion is focused on registered Canadian savings plans. If you live outside of Canada, however, keep watching, as there may be similar types of plans or accounts where you are living. You just might have to do a bit of your own research to find out what's available for you personally. But if you are in Canada, definitely keep watching. The Canadian government offers some excellent incentives for saving money. Once you have decided what kind of fund you want to invest your money in, you will need to decide if and when you want to pay tax on that money that you are investing. That's right, you can decide on the tax you want to pay. When you register your investment with the government as an RRSP or a TFSA, registered retirement savings plan, or tax-free savings account, you will be given tax breaks on those investments. There are many more types of savings plans. However, as these are the two that will be the most relevant to the majority of people, these are the two savings plans we are going to discuss. Before we go deeper into registered investments, let's briefly discuss non-registered investments. The only real benefit to not registering an investment with the government as an RRSP or a TFSA is that you can take money out at any time and you can deposit as much as you want, meaning there are very few restrictions on non-registered investments. The only condition is that you have to pay tax on the interest or profits that you do make off of your investment, whether it be a stock, bond, index fund, or any other type of investment. Now let's talk about RRSPs, or Registered Retirement Savings Plans. With an RRSP, you don't have to pay tax on the money you've invested until you take that money out of your investment. This is done by the government giving you your tax back on the amount that you invested into your RRSP annually. When you do take money out after retirement, that money counts as income that you have to pay tax on. This sounds counterintuitive, as you still have to pay tax on that money. However, even though you still have to pay tax, if you invest intelligently, you will have a lot more money built up by the time you have to pay tax on that investment. With RRSPs, you can take money out at any time, but you'll have to pay extra tax on the money you do take out if it is withdrawn before retirement. As for deposits, you can put in up to 18% of your annual earned income. If you don't invest the full amount each year, your RRSP contribution limit will carry over indefinitely. So if your contribution limit one year is $10,000, but you only put $8,000 into your RRSP, then the next year you will be able to deposit up to $12,000. You can use almost any investment as an RRSP. This means that you could set up an index fund and register it as an RRSP, so you don't have to pay tax on the money that you're depositing until after retirement. Last is a TFSA, or tax-free savings account. With TFSAs, you pay your regular income tax, but any money that you put in or take out after that is tax-free. This was implemented by the Canadian government to encourage Canadians to start saving money. Unfortunately, not everybody knows that this program exists. The benefit to this is fairly straightforward. When you put money into a tax-free savings account, you don't have to pay tax on any interest or profits from the investment while it is invested, or when you take it back out, which could mean a lot more money back in your pocket. With TFSAs, you can put in $5,500 annually. So if you don't add money for 2 years, you'll be able to add $16,500 the third year. That being said, assuming the index of the American market continues to go up an average of 10% each year, that $5,500 per year, compounded over the course of a 45-year career, would leave you with a retirement fund of $4.35 million tax-free. Not a bad chunk of change. Like with RRSPs, you can use almost any investment as a TFSA as well. Part 5. How to protect yourself from the volatility of currency exchange rates. This is done through something called hedging. A hedged fund is just a way to convert your investments from a foreign currency into your native currency. Let's say you're Canadian wanting to invest in the American market. With a standard fund, the amount of money you make could be affected by the differences in the value of the American and Canadian dollars. What hedging does is it removes that factor. You can invest in an American fund, and even if the Canadian dollar drops or increases, all of your returns will be relative to the American dollar. So if the investment you made goes up in value by 20%, you will make 20% no matter what the value of the Canadian dollar is. You will know that an investment is hedged when you see at the end of the title of the investment there's the word hedged in brackets. This just adds an extra element of security to your investment, as it entirely removes a factor that could greatly reduce the value of your investment, the exchange rate. Part 6. Where to go to make investments. Now that you have all the knowledge to make smart investments, where do you go to actually make these investments? There are 3 options. You can go to a bank and ask to talk to a broker or investment advisor. You can go to a registered private investment firm and talk to a broker there who can make the investments for you. Or, the third option, is you can download an app on your phone or online where you can do your own investing through an online brokerage like Questrade, which allows you to do all your investing from home. No method is better than another. They are purely a matter of personal preference on who you want handling your money. Part 7. The Big Picture. This section is less about investing and more about my personal vision for the future and how investing can help solve major issues globally. Consider this. There are hundreds of thousands of families in North America alone who can afford to put away up to $500 per month into long-term savings. If we were to go beyond retirement and look at how much money could be made through compounding index funds over a full lifetime, the numbers start to get a little crazy. $500 per month over a 45-year career at 10% interest compounded annually would leave you with a retirement fund of over $4.5 million. 10% of that $4.5 million is $450,000 that you would be making just off of the interest from your investment each year. Now let's say through retirement, you lived off of $90,000 per year that you were taking from your investment. By the time you turn 80, your investment would still have grown to over $14.2 million that you would have to pass on to your kids. $14.2 million. Every generation of your family moving forward would have an immediate head start on life, as that investment continues to grow and grow and grow with the economy. Now imagine if every middle-class family in North America did that. The rich would still be getting richer, but by bringing up the middle class along with the rich, there would be enough good people out there with the means to provide funding to help solve major social issues like homelessness, education funding, medical research, and any other challenges people want to address. A couple generations of intelligent investing, and the middle class could really begin to drastically change the world for the better. This is why I believe everybody needs to share this course for everyone to see.